All right, Shan, I mean, it's pick your spot. Right? We could close above 6,800 on the S&P. We could close above 2,500 on the Russell. And we are going to close above 47K on the Dow.
Yeah, it's really the so what shutdown story, Scott. We're moving into another week of a government shutdown, and yet, we got the data release we needed, right? The inflation data release, which continues to be supportive of what the Fed wants to do. They want to make sure they haven't seen that payroll data, but they can make some assumptions on secondary data to know what that looks like. As we go into next week, we've had a couple of hiccups, and I think that's really the story. We've seen some of those credit concerns crop up. We've seen some questions about valuations and vendor financing, and yet this market continues to move higher.
Mike, it's pretty impressive. I mean, what sticks out, do you think, most to you?
I think essentially that it took very little in the way of a reset in prices to allow the market to kind of get back in gear. Because you did see some slippage in the gears. 2 weeks ago today, what actually happened? Well, you had this suggestion of re-escalation on trade, which identified a node of complacency in the market, that we had sort of set aside the tariff pressures, the threat there. So you had to be tested for that. At the same time, little of the credit hiccups. And we buckled a little bit, but didn't break. And I think once people saw that the momentum trade was not actually going to take the whole tape down, you got the macro, as far as we can tell, that we need. That being said, today's action is interesting. It's what I would call a gap and nap, right? We pop 1% on the open and just sit there because nobody wants to sell it because everybody knows what the calendar says and earnings are coming through and all the rest of it. But it's also not a lot of urgency because guess what? Nobody really sold, so nobody has to buy back in. So I think that's why it's this kind of upward grind is probably a default understanding of what's going to happen. I heard the discussion about the retail trader. There's no doubt hyperactive, very hard to kind of, handicap how that goes, except that there's going to be more buying than selling on average. But we could have said the same thing in the first quarter of 2021. Literally, it was said in the first quarter of 2021, hey, it doesn't matter these companies have no profits. Retail wants them. And it works until it doesn't. So I'm totally in line with the idea. Path of least resistance is higher, but we're starting to maybe get to a point where the market's going to identify another node of complacency somewhere along the way.
And Shannon, it feels like trade is not going to be the thing that knocks this market down enough because every blip lower or even more significant than a blip move lower on a trade headline is bought. It's got to be something else.
Absolutely. This is going to be about China in 2026, Scott, and it's going to be much more limited in terms of sector and industry. It has to be fears about the potential for a more meaningful economic slowing. And right now, whether you're looking at the data we have or the data we don't have, we're not seeing evidence of that, and that gives the market some foundation for continued rally.